Welcome to the deep dive. Today, we're really getting into it, diving headfirst into the world of cryptocurrency. It can be pretty bewildering stuff.
For sure.
And our guide is this book, Easy Money, by Ben McKenzie and Jacob Silverman. We're aiming to go beyond just the headlines, you know?
Yeah, skip the hype.
Exactly. Understand the mechanics, the speculation, and frankly, the potential risks involved.
Absolutely. And look, if you want to get up to speed quickly on crypto without wading through tons of dense material, this is kind of your shortcut.
Right. We've pulled out the key bits, the surprising stuff, hopefully giving you a real sense of it all without the overload of jargon.
Less swimming in jargon, more actual understanding.
So our mission today is basically to unpack crypto. Like, where did it come from?
Yeah, the origins.
What caused that massive price surge? What about the booms and the busts and all this talk about fraud?
It's persistent, isn't it?
And finally, what about the promise? You know, this financial revolution idea versus the actual results, the failures.
We'll be leaning heavily on easy money, yeah. It pulls from economics, history, some real digging.
Okay, so where's the starting point for untangling all this?
Well, the authors kick off with this concept of casino capitalism.
Okay.
It's a term with roots going back, but it really connects to what Keynes observed back in the 30s.
John Maynard Keynes.
Yeah. He saw how these unregulated stock markets were swinging wildly. Pure speculation, like betting, almost.
And that casino idea feels, well, pretty relevant for crypto, doesn't it?
It really does. A lot of economists see it as a zero-sum game. For someone to win, someone else has to lose.
Right. It's not necessarily creating new value for the economy as a whole.
Exactly. It's more about timing the market getting out before it drops rather than investing in something productive.
So the book's core point here is that crypto isn't really like investing in a company that makes things.
Pretty much. The authors are quite direct. They say cryptocurrencies fundamentally don't do anything. Well, not in the way a traditional business does, right? Think of Apple stock. You own a piece of a company making phones, computers, selling services.
Tangible stuff. Revenue.
Right. Crypto is mostly code. Its value isn't usually tied to a real-world asset that produces something.
So putting money in isn't investing in the traditional sense. More like
Shuffling digital tokens around. Gave it a chance, maybe? You could win, you could lose. But the overall economic pie isn't really growing from the activity itself.
Okay. That leads into another idea they explore, right? This golden age of fraud.
Yeah, that's from Jim Chanos, the investor. He and the authors see this worrying trend of, well, widespread deceit across finance lately.
And how does that connect to Robert Shiller's work, narrative economics?
It fits perfectly. Schiller argues that powerful stories narratives really shape our financial choices, even for something volatile like Bitcoin.
So the story itself can move markets.
Absolutely. Schiller's research shows how these narratives catch on. The book uses the bank run example. Even if a bank's okay, if rumors spread that it's failing.
People panic.
Exactly. The narrative of collapse takes hold, everyone rushes to withdraw, and that causes the failure. The story did it, more than the underlying facts maybe.
And you see that pattern in crypto, the hype, the fear.
You really do. That kind of contagious enthusiasm, and then the sudden crashes. It mirrors that narrative effect quite closely.
Okay, let's pivot to Bitcoin's origins, the whole decentralization thing, cutting out banks. How does the book frame that?
Well, it gives a more nuanced view. Satoshi Nakamoto definitely wanted peer-to-peer transactions, no traditional banks needed.
Right.
But the transactions aren't exactly direct. They get recorded on a shared digital ledger.
A database.
Yeah, a public one.
Yeah.
Maintained by the network, not one central place.
So not totally structureless, but the big innovation was replacing that central trust, right?
Exactly. And Satoshi did that by combining two existing technologies, public key encryption and the blockchain.
And solving that double spend problem was key, wasn't it?
Crucial. Without a bank checking balances, how do you stop someone spending the same digital coin twice?
So how did Bitcoin solve it?
That's where the consensus algorithm comes in. Think of the blockchain like a shared notebook everyone has.
Okay.
Transactions are new pages. Crypto keeps old pages safe. The consensus algorithm is the set of rules everyone agrees on for adding new, valid pages. No boss needed.
So it's a way for everyone in the network, even if they don't trust each other, to agree on the transaction history over time.
Exactly. Without a central middleman, every new block of transactions has to follow the rules. You can't just invent money.
Right. And the majority have to agree that a block is valid before it's added?
That's the consensus part.
Yeah.
The book also mentions Ethereum quickly and smart contracts.
Those automated digital agreements.
Yeah, like release funds only when delivery is confirmed, all handled by code.
Yeah.
Meant to replace things like escrow.
Sounds efficient.
In theory.
Yeah.
But the authors note they often hit practical problems, legal gray areas in the real world.
Okay. So let's talk about the appeal. Why did crypto catch on so strongly? This censorship resistance idea seems big.
Oh, definitely. The vision of finance, free from government control, free from surveillance, financial freedom, almost financial anarchy for some proponents.
The private system.
That really resonated. But the book contrasts that ideal with the reality, how crypto gets used for tax evasion, dodging sanctions, money laundering.
Ransomware too, right?
Yeah. The lack of oversight made it attractive for illicit stuff.
And then came the ICO boom, 2017, 2018.
Oh, man. Felt just like the dot-com bubble, didn't it? New projects daily, often with little substance.
Billions poured in, fortunes made and lost incredibly fast.
That was pure speculation. And yeah, the authors say a lot of fraud, too. Then it all crashed in spring 2018.
The crypto winter.
Exactly. Prices tanked. Regulators like the SEC started cracking down.
Which brings us back to Robert Shiller and his idea of naturally occurring Ponzi schemes. How does that work?
Well, a traditional Ponzi has a central fraudster, right? Promising crazy returns, paying old investors with new money.
Until it collapses.
Right. But Shiller says you don't always need that central figure. A naturally occurring one can happen just from prices going up really fast.
How so?
People see prices rising. They assume it'll continue, so they buy in. That pushes prices higher, attracting more buyers. It's a feedback loop.
Driven by the belief that number go up.
Exactly. That narrative itself becomes the engine, even without a mastermind behind it all.
And this links to what Charles Kindleberger observed about bubbles, right?
Yeah, Kindleberger noted that bubbles almost always reveal frauds happening underneath. When money's easy, risks get taken, and it's hard to tell real innovation from scams.
The book then draws a parallel to the U.S. before the 1930s, before federal securities laws.
Right. Regulation was mostly state-level blue sky laws. Pretty ineffective. It was kind of the Wild West for stocks.
Casino capitalism again?
Exactly what Keynes saw. And as long as prices rose in the roaring 20s, nobody looked too closely.
Until the 1929 crash.
Which led to the Great Depression, and then finally federal securities laws. The main focus. Disclosure.
Knowing who you're giving money to, what they're doing with it.
Precisely. And the crucial point the book makes is that crypto, with its pseudonymity, often lacks that basic disclosure.
Making it similar to the 1920s environment, ripe for deception.
That's the argument.
Yeah.
It creates an environment where it's much easier for scams to operate.
So back to the basics. What are you actually buying with crypto? The value question.
Yeah, easy money really drills down on this. Think about Apple stock again. Value tied to products, revenue, assets, real stuff.
Right. They make things, sell things.
But most cryptos,
Yep.
they don't produce goods, don't offer services, no underlying economic activity.
So the authors call it.
Securitized air, that's their term for it.
Wow. They use that Emperor's New Clothes analogy too, don't they?
Yeah. Everyone pretends to see the amazing clothes, but the emperor is naked. It takes a kid to point it out.
And the authors felt like that kid, questioning this huge industry.
Coming from outside finance, yeah. They felt like they were asking obvious questions about value that insiders maybe weren't.
And Schiller's point about celebrities helping narratives go viral.
Right. Even minor celebs can amplify a story, which leads straight into
The celebrity crypto endorsements. Matt Damon, Gwyneth Paltrow, LeBron, Tom Brady.
the list goes on. All pushing crypto exchanges, digital assets, even those huge Super Bowl ads.
What's the book's take on that?
Pretty critical. They argue the celebs were basically tools, megaphones used to lure ordinary people into crypto casino.
Doesn't absolve the celebs, but points to a bigger machine.
That's the idea. They were part of this larger marketing push.
Okay, let's shift to a really key part of the crypto plumbing. Stablecoins. And Tether specifically.
Right. Stablecoins are crucial for liquidity. They're meant to be pegged to the dollar, making trading between volatile cryptos easier.
But Tether, it's controversial, isn't it?
Hugely. The book highlights the lack of transparency, questions about whether they really have the dollars backing each tether.
No proper audits. Shell companies.
Exactly. Based in the Caribbean, complex structures, and some execs with, let's say, colorful backgrounds. A CFO with a past counterfeiting settlement. A general counsel linked to the ultimate bet poker cheating scandal. It raises eyebrows.
The fraud triangle comes up here too. Need, opportunity, rationalization.
Yeah, the authors suggest Tether fits the bill, and they credit online sleuths like Bitfinex for raising alarms early on.
What about the language used in crypto? Ecosystem, space.
The authors see that jargon as potentially obscuring what's really going on, which they argue is trying to make real money from.
Yeah.
Well, fake stuff.
Makes it sound more legitimate, more complex.
Maybe. Creates this sense of a unified, important field rather than just businesses trying to profit from speculation. Calling them assets or money itself is maybe the first big linguistic trick.
They also compare crypto influencers to MLM promoters.
Yeah, multi-level marketing. The parallel is the focus on recruitment.
Bringing in new people.
Exactly. Influencers hype coins on social media, often based on flimsy reasons, trying to get followers to buy in, like an MLM downline. It's less about the coin's actual use, more about getting new money in to push the price up.
Which begs the question, what is the use case for most tokens beyond hoping the price increases?
That's the core critique.
Yeah.
For many, there's just not much real-world utility.
So it looks like a pyramid scheme sometimes. New money pays off the early folks.
The structure can certainly resemble one. Social media is full of hype, but beyond trading, what problem do most tokens solve? Often, nothing.
And the insiders, the influencers, VCs, they benefit most.
That's the argument. Early adopters and insiders get rich, while the majority who come in later are likely to lose out.
It's a stark picture. The book even mentions communities of scam victims.
Yeah, poignantly, the authors note that perhaps the most genuine communities are the victims bonding together, or the skeptics. It's a system where a few win big, most lose, but almost everyone thinks they'll be the winners.
That idea of community in crypto seems important, but the book is skeptical.
Very. They see it as a tactic, fostering belonging, a shared goal, getting rich, especially among people maybe feeling left out by traditional finance, plays on that human need for connection.
And the mantra, trust the code.
Flawed, according to the book. Code is written by humans. Humans make mistakes, can be malicious. It ignores the human element, the potential for errors or hidden issues.
Plus, they argue most cryptos, besides maybe Bitcoin, are basically unregistered securities from real companies, right?
Yeah, despite the decentralization talk, they often function like company-issued assets.
The book then steps back to look at money itself as a social construct.
Right. Money only works because we all agree it does. It's not inherently valuable. It relies on consensus, like government or shared beliefs.
We accept dollars because we trust others will too.
Exactly. In the U.S., with the dollar as the reserve currency, we barely think about that underlying trust.
And the history of private money, like wildcat banks, is a warning.
Definitely. That era was unstable, full of fraud. Private banks issued their own notes, often without proper backing. Many failed.
Hence the move towards national banking, central banks.
For stability. Precisely. To protect depositors, ensure reliability. The book warns against repeating past mistakes by trying to return to purely private money models, which is what some crypto ideals echo.
History lessons. Okay, let's talk about SXSW. The authors went there.
Yeah, South by Southwest. They organized a panel of crypto skeptics, their first real-world outing as critics.
And their first encounter was ironic.
Very. A big demo space run by Fox Entertainment's new crypto venture, a media giant pushing decentralization. The irony wasn't lost on them.
They met an artist excited about NFTs and gaming, play to earn.
Yeah, but the authors were wary, saw a potential future of low-paid workers grinding in virtual sweatshops.
But the weirdest part was meeting people claiming CIA ties.
That sounds bizarre. They talked about geopolitics, Russia, China, tech races, 5G, AI.
And claimed the NSA found a bug in Signal.
Yeah, with a shaky technical explanation. The whole thing felt off, boasting, maybe incompetence, maybe deliberate misinformation, strange stuff.
Their SXSW trip ended with a TikTok party and bumping into Alex Mashinsky.
Briefly, yeah. The Celsius CEO. Before everything went south for Celsius, obviously.
Okay, shifting gears to El Salvador. President Bukele's big Bitcoin experiment.
Yeah, Bukele adopted Bitcoin as legal tender. Big splash.
Goals were lowering remittance fees, boosting tourism. Come to Switzerland?
That was the pitch. But the reality, as Jacob found when trying to use the official Chivo wallet APM,
What happened?
no standard KYC ML checks, know your customer, anti-money laundering, big red flag for potential misuse.
And the launch itself wasn't smooth.
No. Coincided with a big crypto market crash. Bad timing.
The book tells a story about Mario Garcia, an early Bitcoin adopter there.
Yeah. Tragically, he got caught up in one of Bukele's crackdowns. Arrested, harsh prison conditions, no formal charges, shows the human cost, the authoritarian side, even for supporters.
Then there was the plan for Bitcoin City, volcano-powered, tax-free.
Very ambitious. With a new airport funded by volcano bonds.
The authors visited the site.
They did. Spoke to Wilfredo Claros, a fisherman facing forced eviction for the airport, getting minimal compensation, losing his ancestral land for the crypto dream.
And on top of that, reports of government deals with gangs.
Yeah, El Faro, a respected news outlet, reported secret deals undermined Bukele's narrative of bringing peace and security.
Okay, back to the wider market crash of 2022. It started with Terra Luna.
Yeah, the collapse of that stablecoin ecosystem sent shockwaves. Duquan's famous "deploying more capital steady lads" tweet during the meltdown.
It became iconic, didn't it?
In a bad way, yeah.
Yeah.
Symbolized the denial.
Then Celsius imploded, the platform promising huge yields.
Up to 18%. Unsustainable. The book calls it Ponzonomics.
And the terms of service were problematic.
Very. Basically gave Celsius control over customer deposits. So when they went bankrupt, users might lose everything.
The book compares this to the lead up to 2008, shadow banking.
Right, drawing on Hillary Allen's work. DeFi is a new shadow banking system. Similar issues. Too much leverage, rigid systems due to blockchain's irreversibility and smart contracts, complex links making it fragile.
Prone to contagion.
Exactly.
A really key moment in the book is the interview with Sam Bankman-Fried, SBF.
Yeah, getting access to him was significant.
What was the vibe?
They felt he was very carefully managing his image, downplaying risks, blaming macroeconomics for crypto's fall.
Evasive on fraud questions. Tether.
Noticeably so. Nervous laughter. His comment about stablecoins being only roughly back was worrying.
And cagey about political donations.
Very. Despite public records showing huge donations, mostly to Democrats, he later claimed off the record that Tether's leaders were emotional guys. He didn't want anger.
So the impression was carefully constructed, maybe hiding something.
They left feeling uneasy, sensing he knew things were more precarious than he let on, a feeling he was managing a complex, maybe unsustainable narrative.
And then FTX itself collapsed.
Yeah, the contagion spread. After other bankruptcies, news broke about Alameda Research's terrible financial state.
Alameda was his trading firm, right?
Yeah. Then CZ from Binance announced they were selling FTX's token, FTT.
Triggering a bank run.
Classic bank run on FTX. The myth of Alameda's genius trading evaporated, revealed as a risky, poorly managed hedge fund with huge losses.
Even the kimchi premium story was exaggerated.
Apparently much smaller, shorter-lived than the legend suggested. SBF's image as a wunderkind was largely PR, the authors argue.
After the collapse, SBF still tried to spin things, claimed secret GOP donations.
Yeah, via dark money. But FTX's failure sent massive shockwaves, even hit Binance with withdrawal surges and regulatory heat.
The book really drives home the human impact with Reverend Henson's story.
It's heartbreaking. His father, Hal, got into online trading, then fell for a crypto scam called Stallion Wings.
Manipulative tactics, demanding fees for withdrawal.
Exactly. Kept asking for more money tips, commissions. Hal got deeper and deeper in, trying to recoup losses.
Used his retirement savings, home equity.
Everything. Borrowed from everyone. His son David tried desperately to warn him, but Hal couldn't face it.
And tragically,
He took his own life. The book stresses how these scams prey on the desire to provide for family, turning it against people.
And the scam company's response to his desperate email.
Just one word. Okay. Chillingly callous. Underscores the cruelty.
In the epilogue, Ben McKenzie talks about testifying before Congress.
Yeah, the Senate Banking Committee, after FTX. He called the crypto industry potentially the largest Ponzi scheme in history.
Strong words. What about accountability since then?
Well, several FTX execs pleaded guilty, cooperating with prosecutors. New York's AG sued Mashinsky from Celsius for fraud.
And the DOJ went after another exchange, Bits Lotto, linked to Binance.
Right, for money laundering, though Binance itself wasn't charged in that specific action.
Meanwhile, El Salvador is still pushing Bitcoin.
Yeah, passed laws for that Bitcoin bond.
Yeah.
Still moving forward despite the market chaos.
And Wilfredo Claros, the fisherman.
Still facing eviction for the Bitcoin City airport, with compensation they deem inadequate. The project rolls on.
The book ends on a surprising note. Monopoly Jr.
Yeah, the author playing with his daughter. Found it oddly reflective of capitalism, and especially crypto. Fast-paced, luck-based, endless bailouts with paper money.
Like crypto's volatility and perceived endless potential.
That's the parallel he drew. A surprisingly accurate metaphor for the speculation.
So, wrapping up this deep dive on easy money, What are the big takeaways?
Well, crypto's highly speculative nature, for one, the clear echoes of past bubbles and frauds, the huge regulatory challenges.
And the human cost.
Definitely. Reverend Henson's story really hits that home. The technology, blockchain, might have potential elsewhere, but its main use in crypto today raises serious questions about protecting investors and the risk to the financial system.
So here's a final thought. Considering history, considering this book, what's the real future for crypto, this social construct?
Yeah, and what lessons do we need to learn about preventing these manias, protecting people from exploitation in these new complex landscapes?
It makes you think about regulation, individual responsibility, and just critical thinking when faced with these evolving technologies, doesn't it?
It really does.
Thank you for joining us for this deep dive. We definitely encourage checking out the source material and continuing to question the narratives around new financial tech.